Hello and welcome to this video. Today I'm going to be doing a stock analysis on Teladoc. Now, if you don't know what they are a service which people can use for doctor's assessments over the phone, given the name Teladoc for telephone. Now, find them quite interesting because they work with a lot of insurance companies and pension companies and other companies regarding to health problems. So, say you have something, let's say a bad shoulder, and you want to know if your symptoms are true or not, and but you don't want to go to a doctor, you can just call them or have Teladoc call you, say it's part of your insurance. Then they can say, okay, your symptoms are X, Y, and Z. Then you should go see a doctor because it could be these things. And then they might also say, okay, you definitely have the symptoms of these. Let me prescribe you a drug. In some countries they are allowed to do this, some countries they are not, and in other countries they are simply that's okay. Maybe you need physical therapy, you need chiropractor, or and also you need a psychological assessment and stuff like that. So I like the stock quite a lot because I recently learned that the biggest insurance company in Norway called Gjensidige recently signed a contract to use Teladoc in every country they operate, which is Denmark, Sweden, and Finland, and of course also Norway. So very, very interesting at the moment. Very interesting. And also just the fact that they are the biggest player and they are taking market shares and just the way that they operate this eccentric way, say in the United States where it's extremely expensive to go to the doctor, well, then you can just call them and they can tell you what's wrong, and it's a lot less expensive because you don't have to see a actual physical doctor. Now that this is kind of the same business model with hims and hers. Now, if you take a look at the stock over the last time, as you can see here, it's in December in 23, it was up in 23 almost, and it came from even higher up here. Let's see here, all the way up from even higher than this, as you can see almost was that 3 years ago? Yes, it was at $98, so it has been much more expensive. And during COVID, it was trading at $231, and is the max, I believe. So be a bit wary because this means that a lot of investors is sitting with a loss in this stock. So if it sometimes takes these bullish runs, as you can see here, where it trades all of a sudden from 9 all the way up to 15, and then it tanks again, this is most likely because some investors are taking profits because they just want to get out or reduce their losses. Now this one is also just because of their earnings here. As you can see, they were below expected, which is definitely also a reason why they fell down. So yeah. Now the stock itself I do like quite a lot just because I like the company, and we see where we see it is right now is actually laying on a previous support point, as you can see right here. We are laying on a previous support line right here, which is a previous top. So we are of course minus 2% for the day, but if we can rebound here or just make a bottom position here where it flats out a bit, then chances are it might increase. Now this isn't going to be a stock that is going to be your winner, but and make you millions, but I think it is quite interesting. It might be at this point, to be honest, because it's just so cheap. I could definitely see this within the next 5 years being worth 50 to 60 bucks. So like a couple 100% up. I could definitely see that happening just because I like the way that they operate. Now, of course, remember this isn't financial advice. This is purely for entertainment and educational purposes. Now, if we look at the market cap of the company, it is 1.3 billion. So some hedge funds and some other funds like BlackRock might not be able to allow to purchase them simply because it is too cheap, which means it is too volatile. So that's something to be wary of. Chances are it is mostly retail investors and smaller banks and smaller funds buying into this. Now, as you can see, their earnings here for the 24, they got quite decent most of the time, and then we have this outlier here where they were down by 1,327%, which is quite poor. And then again, of course, we see up 31% the quarter after, and then down 7.8%. So we do have an outlier here, which is quite unfortunate. But this means that typically they guess quite correctly. You can also see here annually that they make billions. Of course, they also lose billions some years, as in this year they lost 13 billion, and that is simply because they were expanding, I believe, their servers and just their staff and everything in the company to make sure that they could increase their service. And as you can see, it clearly paid off since that they are not, they don't, what can you say, they haven't gone off the stock exchange yet. So yeah, it's quite interesting to see that they're still here, even though they lost quite a lot. So they are quite a lot in debt, which is something to be wary of course. But yeah, it is an interesting company, and I do think that they are in a bit of a blue ocean because we don't see that many online or teledoctors like this. We also have a company like DocShock, but I don't believe that's quite the same size yet. Now, if you look at seasonal here for the stock all the way back to 2015, you can see this is really different each year. We see 100%, 100%, 70%, 36%, and then we also see a lot of minuses. So we have more negative seasons than great ones. The last time we had a season that ended in a plus, that was 2020, so that was 4 years ago. So quite poor also last year, as you can see, are down by 58%. So it is a bit risky. It is quite a bit risky. If you look at the technicals on it, you can see for the day it is a sell. For the month, it is still a sell. We do see some oscillators moving over towards the buy, but moving average is still a strong sell, and so is the summary. So yeah, I wouldn't purchase into this yet. I would at least wait until it flattens out a bit or maybe gains a bit of traction. And as you can also see, there is still quite a lot of space between the 200-day and the 50-day moving averages. Now the analyst rating of this is up by 34%. Average, as you can see here, we have quite a lot, 26 analyst ratings on this in a stock that's worth, what was it, $1.3 billion? Yep. And but then again, you look, they also have 5,500 employees, so they are quite a large company. So I don't think that is actually is not unrealistic to see these gains, to be honest. So yeah, I would say maybe 9.2 would be my yearly target, so a bit below the average, but that is because it isn't performing that great yet. But I think I like to see that we have so many ratings and none of them are crazy high. We don't see any 30, $40. I think 5 years it could definitely be trading at $50 to $60, as I said earlier. But right now, I like to see that analysts are quite realistic in this stock. Sometimes we see analysts go way crazy, just either minus 80% or plus 500%. But we don't see that here, which I find quite interesting. Now, if you did like this video, please don't forget to like and subscribe.